Apollo Hospital surges after delivering a good set of numbers where margin and profit both came in better than estimates. The management tells CNBC-TV18 that occupancy could increase to 68 to 70%, also on the lookout for acquisitions.
Well, Muthoot Finance climbs on the back of a strong showing in the fourth quarter. The AUM growth was strong as gold prices surged. Brokerages Morgan Stanley and CLSA raised targets, expecting strong loan growth in FY25.
Jio Financial Services slips even as it announces the launch of their beta version of Jio Finance app, which integrates digital banking, UPI transaction and bill settlements.
Zomato slides as brokerage firm Macquarie downgrades the stock, citing a rise in competitive intensity. This comes as Jio Mart plans to start delivering groceries in 30 minutes from next month.
Welspun Corp comes under pressure after the weak quarter. Margins contract while EBITDA slips 21%. The company's guidance remains muted with revenue growth expected to be flat in FY25.
Hello and welcome to Chartbusters. I'm Najla D'Souza. Join me as always is Mangla Malu. Well, it's a big weekend that we're bracing for. Later this evening, we'll get the inflation data coming out of the United States, the PCE data to be precise. Tomorrow, in fact, we'll get the exit polls. And then on Sunday as well, you have the OPEC meet. So Mangalam, plenty of cues coming in there. And the markets are a little bit nervous. You can just look at the screen. We were up 150 points. Now we're up only around 50 points. The mid-cap index as well, from trading well in the green, you had way more number of stocks in the green. That's quickly turned around as well. So some nervousness in the market may not be such a bad thing because you're going into the event light. If the outcome is favorable and there is continuity, then we could see a bazooka move on the upside as well.
Speaking about a bazooka, let's add music to it. The Beatles say, "Hey Jude, take a sad song and make it better." How about "Hey June, take a nervous market and make it better"? So that'll come by, and life goes on. There are a lot of cues. We'll keep an eye out on how that pans out.
You want to go for a couple of lines, Manglam, of the song?
No, there'll be a copyright strike. Definitely, given our singing, Nigel. But what we'll do is we'll actually, get you some ideas for profit. That's what we're more proficient at than singing. This one comes in from our colleagues at Money Control Pro. Sachin Pal joins in with a stock that he's tracking closely.
Logistics company TCI Express has delivered stable performance in FY24. Revenues for the full year, in fact, came in around 1,250 crores, which were largely unchanged over last year due to muted demand conditions. The margins of the company also remained firm around 15-16% for the past several quarters. The company has in fact added almost 25 new branches in the last fiscal year, taking its total branch count to 970 at the end of FY24. The company also incurred a capex of almost 50 crores in the last fiscal year, and the capex plan for the next 3 to 5 years is pegged around 500 crores. The company has recently commenced the automation of the sorting center at Pune, and going forward, the company will be looking forward to replicate the same at its Mumbai and 3 other centers. Well, the company's capex plan will largely be met through internal accruals. The company generates an operating cash of almost 150 on an annualized basis. The business remains very stable, and the company continues to grow its distribution footprint through an asset-light business model. The stock has in fact corrected almost 50% from its all-time highs and currently trades at around 23-24 times 1 year forward earnings, which we believe is very reasonable for accumulation from a long-term standpoint.
All right, that's about TCI Express, an idea for profit coming in from our colleagues. Let's talk about Honasa Consumer. Now, the stock has been a big mover. It's in focus for a bunch of reasons. The fourth quarter results, and more importantly, along with the results, they announced an acquisition as well, the R&D capabilities of Cosmogenesis Labs. So to discuss this and more on their business outlook, how they see the year going ahead, we're joined by Varun Alag, who's the chairman of the company. Thanks a lot, Varun, for joining in. Always good to see you in. Let's talk about this acquisition first. You've spoken about, the R&D capabilities that you get from Cosmogenesis. They have a formulations expertise, R&D lab, and a nano manufacturing capability. What you haven't told us is the value of this deal, what it does to your ROI, and what it does to your R&D spends as a percentage of sales going forward. So tell us about all of those.
Hey, hi, good morning. Thank you for having me on the show. I think, firstly, like we have mentioned in the past, that innovation and product quality is at the heart of what we are building, right? Because we clearly realize that, we are crafting for Indian consumers, keeping Indian skin, Indian weather in mind, right? And hence enhancing our capabilities in that direction, gets us even more love from consumers. And we've been building that organically for the last 5 years. And now with this opportunity, we had been working with Cosmogenesis as a partner for the last couple of years, and whereby we were able to actually engage with them and understand their capabilities. And they have existed for almost 25 years, whereby they have developed over 5,000 commercial formulations for other FMCG players as well as the D2C startups in India. And we wanted to deeply engage with them and their team, right, and bring all of that expertise into our company, which is what we have done with this acquisition. And not only do we get access to an understanding of the knowledge in IPs that they have developed in the past, right? But more importantly, Rohini, who's an expert R&D professional for the last 25 years, joins us as a vice president R&D, and her team, right, also full-time joins Honasa, right, to support all our brands in terms of innovation and R&D. And from a value perspective, right, I think this is something that we have been able to establish at a very fair value of 4 crores. Right? And with that, we've been able to get access to a lot of amazing new category formulations, which will help us expand our TAM over time.
Okay, all right, Varun. Hi, good morning and good to see you, Ben. So it's a small acquisition, but as you said, it's a strategic one in nature. Let's move on in terms of business then. For the coming year, that's FY25, what kind of a growth can you guide? FY24, by the way, was pretty strong, close to 30% growth on the top line. Margins went to around 7% odd. But what it did in the past is what the street appreciates, but they want to know what's the way ahead. So guide us on that.
So I think we have talked about the fact that we want to continue to deliver growths which are significantly better than the FMCG sector, and continue to gain share. In line with that, we are confident of delivering ahead of 20% growth as we get into FY25. Right? And also our plan will be to make sure that our bottom line grows faster than the top line. Right? And we are able to further improve on our EBITDA profiles in FY25.
All right, so bottom line grows faster. That means margins will improve. By how much? 100, 150 basis points, 200 basis points?
Yes, around 150 basis points is what we would plan to.
All right, 150 basis points. So we're bracing for 20% revenue growth with margins closer to 8.5%, 8.6% in FY25 itself. What about ad spends? I mean, you managed to expand your margins in FY24 without diluting a lot of ad spends as a percentage of sales. That leverage is still to play out. 34.4% is what you ended this year with. Where do you expect that to go as your brand scale?
So Mangan, like we have talked about, I think there is a lot of leverage which does exist in our ad spends. But at this point of time, we also feel that we are at a stage where we're still building our brands. Right? And our oldest brand is 7 years old, right? And rest of them are younger than 4 years young, right? And we are competing with brands which have existed for multi-decades. In fact, half a century plus old brands is what we are competing with, which have been doing their awareness spends for 50 plus years, right? And hence it's important that we invest in brand building, because that's the one investment which will pay for decades to come, right? Because once awareness is built, it does help you, right? That said, that is the largest place from which we expect to see leverage as we get into the current year as well, right? Followed by, of course, OPEX leverage, right? Which will help us sort of, get to that improvement of 150 basis points that we're talking about.
Right. So we'll speak about that leverage as we come to it. But just to follow up on that ad spends itself, you're growing your brands, but, the advertising regulator perhaps may be a little perturbed because there were 187 ad violations in FY24. That's ASCI speaking about Mamaearth, and that's higher than all the others who advertise. Do you have a comment on that?
So, Mangalam, actually, it's not being seen in the right light. Right? Out of those 187, 95%, right, are actually not communications which the company has done. They're basically influencer posts, right, on which an influencer forgets to sort of add a collaboration tag or sponsored ad tag, and which gets raised, and then we reach out to those influencers and we tell them, please, you have to add these tags and correct them. Right? So it's not exactly advertising which is being made by the company, right? But more of influencer activation, which is being done by the influencers, where if they're forgetting something, right, and we end up doing like 5,000 to 6,000 such collaborations in a month, and whereby some of this is being highlighted. So it is actually not comparable to a communication which is being made by companies. And all of these are largely that hashtag being missing, and almost in 100% cases, we then tell the influencers to correct it and add that hashtag. So it is all coming out of that. The numbers look large, but they are actually not really communications which we are developing.
All right, Varun, thanks for clarifying that. By the way, I enjoy, on your personal Instagram page as well, quite interesting stuff, fun stuff, that's pleasant to the eye. Let's talk about business, though. Offline as a percentage of your total mix, where does it head? And also, I think new products are at around 18% of your mix. How do both these two shape up?
So innovation, as we have talked about, I think we're amongst the few companies who understand consumer needs, consumer trends, right, and are able to map them really quickly. And we take pride in the fact that we are able to provide such innovations to the consumers, which they love. Right? And that will continue to be, heart of the business in terms of driving more consumer love and adoption in different categories. Right? Outside of that, offline is a journey which we started 4 years back. Right? We've been doing well in that journey. We have been gaining distribution. Right? Over time, we have now hit almost 180,000 outlets, right, in terms of distribution. Now, as we scale, we are also improving our direct distribution, because a lot of distribution that was coming to us was coming indirectly because of the brand pull, right, for which we are now deploying very high quality FMCG distributors across the top 50 cities. And that is what we intend to fully achieve in FY25, so that from the next 10 years perspective, our distribution ecosystem and infrastructure is able to support all the other brands which also will go offline over time.
So the universe is over 9 million outlets. You are at sub 2 lakh. What's your target for the next couple of years?
For the next 3 years, I think we would like to get to about 400,000 to 500,000 outlets, right? Because we are also a mass premium priced player, right? And for us, value-weighted distribution is more important than numeric distribution, right? And that's what we would like to chase. We would want to be in quality of outlets, right? Rather than just chase quantity.
That sums up perfectly. And one of the other things that you did was you diversified away from Mamaearth earlier, and some of those diversifications doing extremely well. Dermaco hit that ARR of 500 crore, and now you have targets of 1,000 crore for Dermaco, 500 crore for Aqualogica, Dr. Sheth's, and 250 crore for Be Blunt. Again, you've given us these aspirational targets. The street likes what you're saying. The stock is higher as you speak. Give us the timeline. By when does Dermaco hit that 1,000 crore ARR? And 500 crore for Aqualogica and Dr. Sheth's. By when?
So our plan would be over the next 2 to 3 years. Right? These brands should hit these ARR marks. Right? We are at it. Right? We clearly understand that one consumer cannot be boxed into just one type of consumer, that they only buy naturals. They for different occasions and needs, they want to buy into different brands. Right? And as a company, we want to be the company of choice, right? When it comes to beauty and personal care for all their occasions, right? Which is where this house of brand strategy helps us.
Do these break even on the EBITDA? Dermaco, of course, is EBITDA positive now, but what about Aqualogica and Dr. Sheth's?
They will also follow the same journey. They're young brands, and they're in investment mode. But as you have seen in Mamaearth and now in case of Dermaco, and as they scale, as they get to a certain size, and they're able to sort of turn that around. And like in case of Dermaco, Aqualogica, Dr. Sheth also have better gross margins compared to ME, so they would probably end up doing in line with where Dermaco was able to achieve the EBITDA positive.
Got that, Varun. Appreciate you stopping by, giving us some clarity with regard to that small acquisition and business for FY25 as well. We look forward to chatting up with you as the year does progress. For the time being, we'll slip into a short break. On the other side, we'll get chatting with the management of CMS Infosystems. Stay with us. Well, let's get straight to the next management. CMS Info Systems, that's the one on our radar. We have with us Mr. Rajiv Kaul, who is the Executive Vice Chairman, the whole-time Director and the CEO of the company. Hi, Rajiv. Good morning and good to see you in after a while. Well, for the year, I think you'll have laid out a guidance of around 2,500 to around 2,700 crores. Do you think you'll be able to hit the upper end of this range? Tell us that. And also tell us about the vertical splits, cash management as well as your MS segment. How much will both of these grow?
That was a very quick, direct question. I thought at least we'll talk a little bit about last year's performance.
Last year's numbers, Rajiv, we have. We want to know the way ahead now.
Well, you know us well, Nigel. At the company, we sort of only give a revenue guidance. Our revenue guidance for FY25 was to grow to a 2,500, 2,700 crore range. And you're right, we have already updated in our investor presentation. We are looking to hit the upper end of the guidance. We feel reasonably confident about achieving it. On your next question on the split of businesses, our managed services and technology business has grown very rapidly. In fact, the CAGR growth for the last 3 years has been above 30%. We do expect that business split to be 60-40 between our cash logistics business and our managed services and technology business, which is what I think we almost achieved that number in FY24. And we feel confident that FY25 will also be in that zip code.
Okay. What does this mean then in terms of margins? Because the managing service business has been, it's high teens in terms of margins, while a cash logistics business, well, that gives you better margins. So on a blended basis, what does margins look like?
Well, I think you have to think of margins from different angles. One is the percentage margin, which I think the street focuses overtly on. I think that what we really focus on growth in the margin. I think a growth in the margin, whether if you think of the managed services technology business, I think that's grown at a CAGR of about 39% over the last 3 years. So the margins quality there is improving. I think what is again important to tell investors is that our ROCE has been fairly strong. Our ROCE has expanded by 200 bips from an average of 25% to 27.4% last year. I think these are very solid return metrics despite investing almost close to 200 crores of capex for growth every year.
So can you maintain the ROCE at around this 27%? And also, what's the capex you've lined up for this year?
So, given the growth opportunity for us right now in all our verticals, we feel fairly confident about the growth outlook, which I've already talked to you about. We are looking at capex investment this year of roughly about 300 crores in that area. And from a ROCE perspective, I think we should look at ROCE over trend lines. Each year may not be the right way. I think we have sort of gone from 25 to 27. I think that's the area where we hope to be in.
All right. So what about market share? I mean, you had an aspirational target of 60% there. The year before that, you did about 46%. Where do you stand at right now? And by when do you reach that aspiration?
Hi, Mangalam. Again, I enjoy this early morning interview. Very, very hard, direct question. But for us, if you think about I'm guessing you're referring to our ADM business market share.
Yes,
cash
that's
logistics.
correct.
So I think that business we are right now around somewhere between 49 and 50% market share right now on that on volume basis, and then revenue would be higher. So, we are making improvements, and either we are defending market share in strong businesses, or we are taking market share in some of our newer verticals like, AIoT and all. I think we've done a tremendous job in scaling that business up in the last 3 years.
And what about the cassette swap? We keep asking you about that as well. Direct questions here too. When does that come up, and what's the benefit?
Yeah, no, I think the benefit is very important from what RBI wants to drive, right? Which is the quality of currency, which is going to be dispensed across the ATM network in India. I think it's a very important initiative. These things take time. I think the first 30 cities of cassette swap rollout have been completed. So roughly 15 to 20% of the network is right now under the cassette swap mechanism for CMS. Now we will be working along with IBA and the banks to see the next set of 30, 40 cities, which will take a year and a half to roll this out. So I think that there is steady and decent progress. It's a fairly complex process change for the entire ecosystem, but good progress. We're pretty happy with the quality of work happening there.
So what is typically the delta of cassette swap? For assets which have cassette swapped, say for every incremental % of cassette being swapped, what is the benefit that comes into CMS?
I think you have to think from the benefit to the consumer, right, and the banking system. I don't think it's important about what CMS benefits. Cassette swap is a very important process to keep the sanctity of the notes which are being replenished and which are available in the ecosystem to be of high quality and genuine. Number one. Number two, a cassette swap process can also help in making sure that the cash utilization ratio is more efficient. You don't need to keep loading more and more currency each time. You are able to run a process which overall banks should be able to save the amount of money which will be sitting in an ATM at any given point of time. So I think those are the two important things. From a perspective of CMS, for us, it's important first is right thing for the country. We were one of the very few countries in the world where you don't have the cassette swap process. So I think it's important to do it from a quality and standards. Overall, I think it'll improve the ecosystem. It'll improve, any reconciliation-related issues, and overall also improve the amount of currency which needs to be, which is sitting in an ATM. I think that can be, you can start bringing that down over the coming years.
Okay, Rajiv, where you took strike and you smacked it out of the park was the AIoT segment. I think it was contributing around 4-5% of your total mix. It scaled 100 crores rather rapidly. How do you see that business shaping up? Any targets in the near term, FY25, FY26? And by when does it hit that 500 crore mark?
You guys are tougher than my board. So, yes, we have done, we're very happy it's done well. We've been lucky that it's scaled from 0 to 100 crores in roughly 3 years. The way, again, we don't give guidances by each BU, but we have talked about this. We feel the opportunity, again, please, remember this word, I said the opportunity. The opportunity for us in the midterm, and let's take the next 3 years, is to grow this at a CAGR of 30-40%. If we are able to do that, if we are able to execute and drive up this business, then the 100 crore can become a 250 crore sort of a run rate. For me, I think that's more important, right? I mean, crawl, walk, run. We would rather see this grow instead of, saying big numbers. I would rather see how do we get to 200 crores in the next 2 years? How do we get to 250 crores in the next 3 years? I think that those are important yardsticks for us internally when we measure ourselves. The revenue contribution, as you said, has already gone from 0% to 5% in a span of just 3 years. I hope to get the 5% contribution to maybe 7-8% in the next 3 years.
All right. So that explains your outlook for the next 3 years. You've also given us an aspirational target of 3,800 crores on the top line in the next couple of years. So let's wrap this up, Rajiv.
3,800 crores. Like Mangalam, I'll say 3,400, 3,800 crores.
Okay, 3,400 to 3,800 crores, if you want to quibble over, the lower end of that guidance that you've given. But the street would like you to achieve the higher end of the guidance. Let's wrap it up with the revenue that you will have, the revenue mix at 3,800 crores. How much of that will be inorganic? How much of that will be, MS? How much of that will be cash management? How much of that will be AIoT? If you could give us a sense.
We actually haven't really dissected FY27 forecast. I think that's something which we will talk about when we do our next investor, summit, analyst day. I think right now, also we want to be careful because we are focusing on inorganic growth. We are, as I said already, we are working on incubating new lines of business. And let's see how that goes on. I think it'll be better. We'll be able to give a better sense once we know how that is going. So I would rather be careful and focus on FY25 for now.
Okay, all right, Rajiv. We enjoy running into bowl, and we appreciate you batting and taking each ball as per the quality fit. Thanks a lot for joining in and filling us in with all those details. For the time being, we take a short break, come back, continue our focus on the markets. Don't go anywhere.
Well, nervousness for the market continues. As you can see at the top of our screens, the market still continues to be volatile. The mid-cap index is under pressure. The frontline indices off highs, off lows, somewhere in the middle. What we'll do is both Nigel and I will take your leave on this edition of Chartbusters. Hopefully by Monday, we'll have a lot more clarity on the events that we spoke about at the start of the show. Thank you for watching.